Have you ever wondered how Warren Buffett can look at thousands of publicly traded companies and somehow identify the few that go on to create extraordinary wealth? More importantly, have you ever asked yourself what he sees that most investors completely miss? Every day, Wall Street is flooded with stock tips, analyst reports, breaking news, and endless predictions about where the market is headed next. Yet Buffett has spent decades ignoring much of that noise while consistently building one of the greatest investment records in history. The fascinating part is that his process isn't based on secret formulas, complicated algorithms, or insider knowledge. In fact, Buffett's approach is surprisingly simple, but far deeper than most people realize. He doesn't start by asking whether a stock will go up next month. He starts by asking whether the business itself deserves to be owned for the next 10 years. That single shift in perspective changes everything. And once you understand how Buffett analyzes companies, you may never look at investing the same way again. What makes Buffett's method so powerful is that he approaches businesses the way an owner would, not a trader. While many investors focus on stock prices, Buffett focuses on products, customers, competitive advantages, management quality, and long-term profitability. He wants to know whether a company can continue making money regardless of what happens in the economy, the market, or the latest financial headlines. Can it protect itself from competitors? Does it have loyal customers? Can management be trusted to allocate capital wisely? These are the questions that guide every major investment decision he makes. But perhaps the most surprising part of Buffett's analysis is that he spends just as much time looking for reasons not to invest as he does searching for opportunities. Why? Because avoiding bad investments can be just as important as finding great ones. Another key element of Buffett's process is his famous concept of the circle of competence. Unlike many investors who try to understand every industry and every trend, Buffett focuses only on businesses he truly understands. If a company operates in an industry that is too complex or unpredictable, he simply moves on. This discipline has protected him from countless mistakes throughout his career. It also reveals an important truth about successful investing. You don't need to know everything. You only need to recognize exceptional opportunities when they appear within your area of expertise. But how does Buffett determine whether a company is truly exceptional? The answer lies in one of the most important concepts in value investing. Buffett is constantly searching for what he calls an economic moat, a durable competitive advantage that protects a company's profits from competitors. It could be a powerful brand, a dominant market position, a unique network effect, or customer loyalty that is difficult to replicate. Companies with wide economic moats often generate strong returns for decades because they can defend their businesses even as industries evolve. This is one reason Buffett has historically favored companies like Coca-Cola, American Express, and Apple. These businesses possess qualities that competitors struggle to copy. Yet even a great company isn't always a great investment. Buffett also wants to know whether the stock is available at a reasonable price, which introduces another crucial layer to his analysis. At the end of the day, Warren Buffett's investment process is not about predicting the future. It's about understanding businesses so deeply that uncertainty becomes less intimidating. He studies financial statements, evaluates management teams, analyzes competitive advantages, and calculates intrinsic value with extraordinary patience. Then he waits, sometimes for months, sometimes for years. Most investors search for excitement. Buffett searches for certainty. Most investors react to headlines. Buffett reacts to business fundamentals. And perhaps that is the greatest lesson hidden inside his remarkable success. He doesn't invest in stocks. He invests in businesses. And once you learn to analyze companies the way Buffett does, you may discover that the stock market becomes far less mysterious and far more rewarding. If you had the opportunity to sit across from Warren Buffett and ask him how he decides whether a company is worth investing in, you might expect a complicated answer filled with financial ratios, market forecasts, and advanced valuation models. Surprisingly, that's not where Buffett begins. Before he studies earnings reports, profit margins, or stock charts, he asks a much simpler question, one that instantly eliminates thousands of companies from consideration. It's a question so powerful that it has guided some of the most successful investments in history. Yet most investors completely overlook it. Why? Because they're focused on what a stock might do tomorrow, while Buffett is focused on what a business can become over the next decade. This single question serves as the foundation of his entire investment philosophy. And once you understand it, you'll begin to see the stock market through a completely different lens. More importantly, you may avoid some of the costly mistakes that trap investors year after year. The first question Buffett asks is deceptively simple. Do I understand this business? At first glance, that may sound almost too basic to matter. But hidden inside that question is one of the most important investing principles ever developed. Buffett knows that successful investing doesn't begin with predictions. It begins with understanding. If he cannot clearly explain how a company makes money, who its customers are, why they buy its products, and what keeps competitors away, he moves on without hesitation. It doesn't matter how popular the company is or how excited Wall Street becomes. Buffett has always believed that uncertainty is the enemy of intelligent investing. By focusing only on businesses he truly understands, he dramatically reduces the chances of making decisions based on speculation rather than knowledge. This idea eventually became known as Buffett's famous circle of competence. The concept is remarkably straightforward, but incredibly difficult for many investors to follow. In a world filled with social media hype, financial television, and endless investment opportunities, there is constant pressure to chase the next big thing. Buffett resists that temptation. He understands that every investor has limits, and that pretending to understand a business can be far more dangerous than admitting you don't. This discipline has protected him from countless mistakes over the decades. While others rush into industries they barely understand, Buffett patiently waits for opportunities that fall squarely within his area of expertise. It's a strategy that may seem boring on the surface, but it has produced extraordinary results over time. What makes this question even more powerful is that it naturally leads to deeper analysis. Once Buffett understands a business, he begins asking additional questions. Does the company have a durable competitive advantage? Can it continue generating profits 10 or 20 years from now? Does management allocate capital wisely? Are customers loyal to the brand? These questions build upon the foundation created by the first one. Without understanding the business itself, every other analysis becomes less reliable. Buffett often compares investing to buying an entire company, rather than simply purchasing a stock ticker. This perspective forces him to think like an owner, not a trader. And owners, unlike speculators, must fully understand what they are buying. Perhaps the greatest lesson behind Buffett's first question is that investing success often comes from simplicity rather than complexity. Many investors spend years searching for sophisticated strategies, secret indicators, and market predictions. Buffett's process starts with a question that any investor can ask. Yet very few apply it with the same discipline. By refusing to invest in businesses he doesn't understand, Buffett has avoided countless disasters and positioned himself to recognize truly exceptional opportunities when they appear. The next time you consider buying a stock, pause for a moment and ask yourself the same question Buffett asks. Do you genuinely understand the business? If the answer is unclear, that uncertainty may be telling you more than any financial statement ever could, and that simple realization might become one of the most valuable investment lessons you'll ever learn. Every day, millions of investors chase the next big opportunity. They scan financial headlines, follow social media influencers, and rush into the hottest sectors, hoping to discover the stock that will change their lives. Artificial intelligence, electric vehicles, cryptocurrencies, biotechnology. There is always a new trend capturing the market's attention. Yet while the crowd races from one opportunity to another, Warren Buffett often does something that seems almost unbelievable. He ignores most of them. In fact, some of the biggest market stories of the last several decades passed by without Buffett making a major investment. To many people, this seems irrational. Why would one of the greatest investors in history willingly ignore opportunities that everyone else is excited about? The answer lies in a simple but powerful concept known as the circle of competence. It is a principle so important that Buffett credits it with protecting him from countless mistakes and helping him build one of the largest fortunes the world has ever seen. At its core, the circle of competence is not about how much you know. It's about knowing exactly what you don't know. Buffett understands that every investor has areas where their knowledge is deep and reliable, and other areas where their understanding is limited. The problem is that most people struggle to recognize the difference. When a stock is soaring and everyone seems to be making money, it's easy to convince yourself that you understand the business behind it. But Buffett refuses to make that mistake. Before investing a single dollar, he asks whether he truly understands how the company makes money, what drives its success, who its competitors are, and what risks could threaten its future. If the answers aren't crystal clear, he simply walks away. This discipline may not generate exciting headlines, but it has prevented countless costly errors throughout his career. One of the most fascinating aspects of Buffett's philosophy is that he doesn't feel pressured to participate in every opportunity. Many investors suffer from what is commonly called FOMO, the fear of missing out. They watch others profit from fast-rising stocks and feel compelled to join the crowd. Buffett sees things differently. He understands that investing is not a game where the person with the most trades wins. In fact, he often compares investing to baseball without called strikes. In the stock market, you don't have to swing at every pitch. You can stand at the plate indefinitely, waiting for the perfect opportunity. This mindset gives Buffett a tremendous advantage. While others rush into unfamiliar territory, he patiently waits for businesses that fall comfortably within his circle of competence. And when those opportunities appear, he can act with extraordinary confidence because he understands exactly what he is buying. The power of this approach becomes even clearer when you examine some of Buffett's biggest successes. Companies like Coca-Cola, American Express, and Apple were not chosen because they were fashionable. They were chosen because Buffett understood them deeply. He could explain their business models, evaluate their competitive advantages, and estimate their long-term earning potential. More importantly, he could do so without relying on speculation. This ability to stay within his circle of competence allowed him to make large investments with conviction, while avoiding countless businesses that appeared attractive on the surface, but carried hidden risks. Over time, this combination of patience, discipline, and self-awareness created a powerful edge that few investors have been able to replicate. Perhaps the greatest lesson behind Buffett's circle of competence is that successful investing is not about being the smartest person in the room. It's about being honest with yourself. The market constantly tempts investors to venture into areas they don't fully understand. It rewards excitement, confidence, and bold predictions. Buffett's philosophy rewards something different: humility. He knows there are thousands of businesses he will never fully understand, and he is perfectly comfortable with that reality. Instead of trying to know everything, he focuses on knowing a few things exceptionally well. That simple decision has helped him avoid disastrous mistakes and identify extraordinary opportunities when they appear. And in a world obsessed with chasing the next big thing, that may be the most valuable investment lesson of all. Imagine for a moment that you are standing in front of a medieval castle. The castle itself represents a business, while the wide moat surrounding it protects it from invaders. The deeper and wider the moat, the harder it becomes for competitors to attack. This simple image lies at the heart of one of Warren Buffett's most powerful investing concepts, the economic moat. In fact, Buffett believes that the best companies in the world are not necessarily the fastest growing or the most exciting. They are the businesses that possess durable competitive advantages, capable of protecting profits for decades. But how does Buffett identify these rare companies before everyone else recognizes their value? The answer has helped him invest in legendary businesses such as Coca-Cola, American Express, and Apple. More importantly, it reveals why some companies continue dominating their industries year after year, while others slowly fade into irrelevance despite once appearing unstoppable. The first thing Buffett looks for is customer loyalty. A company with a strong economic moat doesn't have to fight for every sale because customers willingly return again and again. Think about some of the world's most powerful brands. Millions of consumers buy the same products repeatedly, often without considering alternatives. Why? Because trust has already been established. Buffett understands that customer loyalty is one of the most valuable assets a business can possess. Competitors may copy products, lower prices, or launch aggressive marketing campaigns, but winning over loyal customers is far more difficult. This loyalty creates predictable revenue streams, strengthens profitability, and gives companies the stability needed to thrive through changing economic conditions. For Buffett, a loyal customer base is often one of the clearest signs that a company has built a moat capable of lasting for generations. Another critical part of the economic moat test involves examining whether a company possesses advantages that competitors struggle to replicate. These advantages can take many forms. Some businesses benefit from powerful brands. Others enjoy network effects, where the value of the product increases as more people use it. Some control unique distribution channels, patents, or cost advantages that allow them to outperform rivals. Buffett isn't interested in temporary advantages that can disappear in a few years. He wants to find businesses that can remain dominant even as industries evolve. This is why he spends so much time studying the long-term economics of a company rather than focusing on short-term stock price movements. He knows that a truly exceptional business can create enormous wealth for shareholders if its competitive advantages remain intact over decades. One of the most overlooked aspects of Buffett's moat analysis is management quality. Even the strongest moat can deteriorate if leadership makes poor decisions. Buffett often looks for executives who allocate capital wisely, think long-term, and prioritize shareholder value. He understands that management acts as the steward of the castle. If leaders make reckless acquisitions, neglect innovation, or misuse company resources, even the most powerful competitive advantage can weaken over time. This is why Buffett carefully evaluates not only the business itself, but also the people running it. Exceptional management can strengthen an economic moat year after year, while poor leadership can slowly destroy advantages that took decades to build. For Buffett, the combination of a strong moat and trustworthy management is often a recipe for extraordinary long-term success. Perhaps the most important lesson behind the economic moat test is that great investing is not about predicting which stocks will soar next month. It's about identifying businesses that can continue winning for decades. Buffett understands that markets constantly change, technologies evolve, and economic cycles come and go. Yet some companies possess competitive advantages so powerful that they remain profitable through all of it. These are the businesses he seeks relentlessly. While most investors chase headlines and short-term opportunities, Buffett focuses on the strength of the moat surrounding the castle. Because in the end, the companies that dominate for decades are rarely those with the most excitement. They are the ones with the strongest defenses, the deepest competitive advantages, and the ability to protect their profits year after year. And that simple insight has become one of the greatest investing secrets of all time.